Hello and welcome to this session. This is Professor Farhad. In this session, we're going to look at corporate alternative minimum tax, or corporate AMT. Now, it's extremely important that if you did not or you don't understand individual AMT, it's extremely important that you understand individual AMT first. I do have a playlist about individual AMT explaining in details individual AMT. Now, you might be asking, why is this necessary? Two reasons. One, individuals and corporate are very similar. So if you understand individual, it's easier to understand corporate. And if you are a college student, you have to know individual before you know corporate. And also, if you're a CPA student, you have to know individual before you know corporate. So you have to know individual, make sure you know individual. Okay? So what is the idea behind corporate AMT? It's the same concept as personal AMT. What is the idea? The idea is there are certain taxpayers, either individuals or corporate, they have a lot of tax loopholes. So the AMT is designed to recapture, to basically make the tax burden a little bit more fairer for all individuals. That's what it is. So just like individual AMT, corporations, they have to prepare two tax returns, one under the regular tax and one under the AMT. So there are two tax returns. Just bear in mind that certain C corporations are excluded from AMT, and those, they're called small c, as long as in the previous 3 years their average gross receipts is 7.5 million or less. So they look at their average gross receipts. As long as it's less than 7.5 million for the past 3 years, they're exempt. Also, new corporations are automatically exempt. So when you're new, you're automatically exempt. So in this session, what I'm going to do, I'm going to go over the overall formula for AMT. Then in the next session, then also I'm going to compare it to the personal. So I'm going to show it to you side by side how similar to the personal AMT is. And that's why it's important to understand the personal. Then in the next session, I will dig a little bit further into the adjustments, into the preferences, and show you the computation with numbers. But here it's an overall picture. Let's go ahead and start. How do we compute AMT? We'll start AMT by taking regular corporate taxable income before net operating income. So basically regular corporate taxable income, assuming you don't have NOL. But if you have NOL, you cannot deduct NOL when you're computing the regular taxable income for the purpose of AMT. Okay, so we'll take, simply put, just assuming there is no NOL, regular corporate taxable income. Just like for personal taxes, we'll start with personal regular taxable income. Here it's regular corporate taxable income, and that's why I put corporate in caps. Then you're gonna plus or minus certain adjustments. Plus or minus certain adjustments. Sounds familiar? That's what we did with personal AMT. We had adjustments. Then we're going to add some preferences. Again, similar. This is same as personal. Same as personal. Then we add certain preferences. Those, notice, preferences are only additions. Then we're going to get to something called pre or unadjusted AMT income. You might be saying, hold on a second. Didn't I just made my adjustments here? Why is it called pre or unadjusted? Don't ask me. You can contact your Congress to ask them, but it's called pre or unadjusted AMT income. Why? Because we have additional adjustments. Then after we find our pre or unadjusted AMT income, and those terms mean specific things, because for example, on the CPA exam, they might only ask you for the pre or unadjusted AMT income. So you need to know the formula, how to get to this point. After that, we deduct or add something called ACE adjustments. Those are new as far as corporate. So those are new. Sometimes they're addition, sometimes they're a subtraction, but they are listed separately. They're called ACE adjustments, which we'll see them. Then we'll deduct AMT NOL, alternative minimum tax net operating loss deduction. So if we have any NOL, that's AMT based on the AMT. And you might be saying, so you're saying we have two different NOL, one is regular, one AMT, and the answer is yes. Why? Because we have different accounting methods. Remember, the way we compute our income for AMT, it's different than we compute it for regular. Therefore, if you have losses, your losses also will be different. For example, the depreciation method for AMT is different than the depreciation method for regular taxable income or regular corporate taxable income. Therefore, your NOL will be different. So if there's any NOL for AMT, it's deducted here. And after we deduct NOL, we'll get to alternative minimum taxable income, AMTI. From there, we can deduct, just like we did for the personal, an exemption. The exemption here is 40,000. Obviously, there's a phase out. We're going to see what the phase out is next. Then that's going to give us, after we compute our exemptions, we're going to get to the AMT base, and this is basically AMTI before exemption. Obviously, then we deduct the exemption, then we'll get to the base. Once we'll get to the AMT base, this is when we multiply it by our tax rate, and notice there's only one flat tax rate. In the personal, if you remember, we had a 26 and a 28%. Well, for corporate, we only have one tax rate, 20%. Here we'll get to the gross AMT, alternative minimum tax. Then we have the right to deduct foreign tax credit, just like individual. And after we do so, we get to the tentative minimum tax, just like individual. And after tentative minimum tax, we compare this to the regular income tax, which we calculated separately somewhere else. Then if the tentative is greater than the regular, we have an alternative minimum tax. And this is basically the overall formula. Now, I'm gonna expand this formula on an Excel sheet while showing you side by side the similarities between individual and corporate. And this is why I kept saying you are better off first learning the individual before you get to the corporate. So let me show you on an Excel sheet. I prepared this side by side so you can see it, and hopefully you can see this. Sorry. So on this side, this side here, you have the individual. Let's go ahead and see what things look like. All right. Regular corporate, regular taxable income, regular corporate taxable income. We have plus or minus adjustments. We have plus and minus adjustments. We have plus tax preferences, plus tax preferences. Then we'll get to the alternative minimum taxable income before adjustments for personal. Now for corporate, here it differ. These are now here it differ. Here we have what I have in red. This is what we call the ACE adjustments. So after we add our preferences, we'll get to unadjusted AMTI. And again, it's unadjusted also. We did the adjustments, but it's called unadjusted. Then we have the ACE adjustments. Now we're going to talk about the ACE adjustments a little bit more later on. So the ACE adjustments are either plus or minus. Then we minus NOL. Then we will get to alternative minimum tax before exemption. Back to similar to the personal income tax. Similar to the personal income tax. Alternative minimum tax before exemption. Then we have an exemption. Same thing. Then we have an exemption. Then we have the AMT base. This is the AMT base. Then we have a tax rate, a different tax rate, but the same concept. Then we have gross AMT. Then we have the credit. Then we have the AMT. Then we have the regular tax. Then we'll take the difference. So basically, the only thing that's difference between the two is the ACE adjustment and NOL. So this is the main difference as far as the formula is concerned, to be more specific. So this part here, ACE and NOL, we don't have them under regular. Actually, we do have NOL. We did not discuss NOL, but let's say mainly ACE. I'm not going to go into NOL. Mainly ACE, the difference between the two. Now, let's talk about the adjustments. The adjustments that we have to not worry about, but we have to know. Basically, we're going to have a different depreciation method for items that are placed in service between 86 and 99, just like the personal, and different depreciation method for items that are placed in service after 1999. So simply put, we're going to have two depreciation method, one for AMT and one is for regular. Now, if we have two different depreciation method, as we said in the previous session, we're going to have different gain and losses because the basis for the assets will have different basis. Therefore, when we sell them, we're going to have different gain and losses. Also, same concept that we did for personal, percentage of completion versus the completed contract. We have to use the percentage of completion. We cannot use the completed contract method for AMT. Installment sales dealer. We cannot use the installment sales dealer. Actually, we'll look at an example later on. Don't worry about this. We have three preferences. Private activity interest. We saw this in the personal. We have excess depletion over adjusted basis. So basically, if we depleted too much, we cannot do it under AMT over the basis. We have to recapture it. And any pre-1987 acres depreciation, which is pretty much those things are being phased out. But those are the preferences. Then we have the ACE adjustments. ACE could be minuses or pluses. The 70% dividend received deduction, that's going to go away. Life insurance proceeds on key employees will be added to income. The difference between makers, this is makers, not makers, and ACE, municipal interest income is included and organizational expenditure is taken out. Those are the ACE adjustments. Then we have then we subtract NOL, AMT NOL, we'll get to the phase out. How does the phase out work? Well, the phase out is this. If your alternative minimum taxable income, if your AMTI is more than 150, for every additional dollar, you would lose 25% of your exemption. So simply put, your exemption starts at $40,000. And let's assume you have AMTI of 170. So this exceeds the limit. The limit is 150. So you are 20,000 above the limit. What we do is we'll take 20,000 times 25%. That's 5,000. 5,000. So you lost 5,000 from your exemption. Your exemption now is 35,000. So basically, hopefully, you know how the exemption works. Eventually, at some point, you would run out of your exemption once your amount is, I don't know what the amount is, but you could, for example, I'm pretty sure, let's see if we said 300, if we double it, let's double it. If we said 150 times 25%, why don't I just do this? This is easier. 40,000 divided by 25, 40,000 divided by 0.25, 160. So if we take 150 plus 160, 310. So if your income is, let's go back to the pen here. So if your income is 310 minus 150, you're 160 over the limit. If we take 160 times 0.25, not 0.25, let's do it again. 160 it's clear, 160 times 0.25, that's going to give us $40,000. So once you reach above 310, you're going to lose your exemption. Okay, this is what I was looking for. So this is an overall picture. Now in the next session, what I'm going to do is start to, fill in with some numbers. Okay, just fill in with some numbers, because numbers make more sense than just saying, here's the formula. If you have any questions, any comments, by all means, email me or see me in class. And if you're studying for your CPA exam, study hard. It's worth it.